Gold hit an all-time high of $5,602 an ounce on January 29, 2026. As of today, it's trading around $4,050. That's down 27% from the peak. Here's what nobody's telling you about that 27%. Gold's done this exact move before. Everyone called the bottom too early, and it kept falling for months. In the next 6 minutes, I'll show you the two numbers driving this crash, the historical precedent everyone's ignoring, and the one price level that tells you when it's actually safe to buy. My name is Moon. I track where institutional money actually moves, not what headlines scream. Stick with me. This one's all numbers, no noise. Subscribe now, and if this helps, hit like. Now, let's get into it. Gold also bounced off $4,850 back in April 2026. That bounce failed. Prices went on to make a fresh low. Here's the precedent. In 2013, gold fell roughly 28%. For the year after the Fed signaled it would start tapering stimulus. Every "this is the bottom" call in the first few months of that decline was wrong. The real bottom didn't arrive until well over a year later. It's down, so it's cheap isn't a price question. It's a confirmation question. A bounce off support and a knee-jerk bounce with no confirmation look identical for the first 48 hours. 2013 proved that the hard way. Number 1, June 2026. USCPI came in at 4.2% year over year, the hottest reading in 3 years. That flipped the market. As of mid-July, CME-based pricing showed roughly a 44 to 58% probability of a Fed rate hike by September, not a cut. Just months earlier, markets were pricing cuts. Gold pays no yield. When real rates rise, the cost of holding gold instead of a treasury bill goes up. That gap is exactly what's pulling money out right now. Let's put a real number on it. 100 ounces of gold at the January POC was worth $560,200. At today's price, the same 100 ounces are worth about $405,000. That's a $155,200 paper loss. Not because you did anything wrong, but because the rent on your money just went up. China's central bank added 14.93 tons of gold in June 2026 alone. That's its 20th straight month of buying, and its largest single month since 2023. The World Gold Council's 2026 survey found 89% of central banks worldwide expect their reserves to grow over the next 12 months. A record 45% plan to buy more themselves. This isn't new behavior. Central banks have been net buyers of gold almost every year since roughly 2010. So two groups are trading gold in opposite directions right now. Short-term funds selling on the rate story, central banks buying on a decade-long timeline. Both numbers are real. They're just measuring different clocks. Iran has restricted the Strait of Hormuz since late February 2026. This past weekend, Tehran officially stated its ceasefire with the U.S. has collapsed. Brent crude is near $90 a barrel as a result. On July 17th, gold touched a swing low near $3,955 as conflict headlines hit. It recovered into a $3,995 to $4,030 range within days as peace talk headlines resurfaced. Normally, conflict is bullish for gold as a safe haven, but this conflict is also pushing oil-driven inflation higher. That inflation is what's forcing the Fed toward hiking instead of cutting. The rate effect is outweighing the fear effect, but just barely. Here's the level that matters. Gold's key support zone sits at $3,940 to $4,000. That's the neckline of a head and shoulders pattern that's been building since October 2025. If that $3,940 level breaks on a weekly close, the measured technical target opens up between $2,750 and $3,300. Now here's the math that separates a good investor from a lucky one. Say you're putting $6,000 to work. Person A puts it all in today, betting this is the bottom. Person B splits it into three $2,000 pieces. One now, one only if $3,940 holds, one only if price reclaims $4,200. 2 dates to set alerts for the next CPI release and the Fed's meeting on July 28 to 29, 2026. You might be thinking, Moon, if the long-term case is still intact, why not just buy now? Fair question. Wall Street's own targets sit above today's price. Goldman Sachs about $4,900, Morgan Stanley about $4,800, and a recent Reuters analyst poll averaged about $4,916. One more nuance. The July 28th to 29th meeting itself is largely priced as a hold. The real fight is over September. It goes higher eventually, and buy today are two different claims. The structural drivers haven't reversed, only the short-term rate math changed. Don't buy because it's down. Buy when 3,940 confirms. Subscribe, hit like, and I'll see you at the next signal. Protect and grow what you've built.